The rise and fall of Aspiration represents a compelling story of how a mission-driven fintech company's promising vision was ultimately undermined by fraud and governance failures. Let's break down this cautionary tale of sustainable banking gone wrong. Founded in 2013 by Andre Cherney and Joseph Sanberg, Aspiration positioned itself as an environmentally conscious alternative to traditional banking. The founders brought impressive credentials. Cherney had worked with Al Gore on climate advocacy and helped establish the Consumer Financial Protection Bureau, while Sandberg had Wall Street experience and founded social impact initiatives. Their thesis was compelling. The four largest U.S. banks collectively lent more than $240 billion annually to fossil fuel projects, meaning consumers were unknowingly funding climate damage through their deposits. The company's growth was fueled by significant venture capital, raising $870 million across 7 funding rounds. Early investors included Allen and Company, Omidyar Network, Alpha Edison, and notable celebrities like Leonardo DiCaprio, who joined as an investor and advisor in 2019. Other celebrity backers included Orlando Bloom, Cindy Crawford, Robert Downey Jr., and Drake. Aspiration's business model combined consumer banking with corporate ESG services. The consumer side featured an unconventional pay what is fair pricing model, allowing customers to set their own monthly fees. Premium subscribers could access Aspiration Plus for $7 monthly, offering enhanced features like higher interest rates and better cashback rewards. By 2021, corporate ESG services, including carbon offset sales and sustainability consulting, represented approximately 70% of reported revenue. The company's product suite was comprehensive. The core spend and save accounts offered free ATM access at 55,000 plus locations, mobile check deposit, and up to 1.00% APY on savings for Plus members. The innovative Plant Your Change feature, launched in April 2020, rounded up debit card purchases to fund tree planting. The Aspiration Zero credit card, made from plant-based materials, promised a tree planted with every purchase. The Redwood Fund, launched in November 2015, offered sustainable investing with just a $10 minimum investment. The fund excluded companies in controversial industries like alcohol, tobacco, arms, and fossil fuels, while claiming to outperform the S&P 500 by 1.99% annually over 5 years. However, beneath this sustainable success story, serious problems were developing. Between January 2021 and December 2022, co-founder Joseph Sanberg orchestrated an elaborate fraud scheme involving fake customer contracts for tree planting services. He recruited friends, associates, and even religious organizations to sign letters of intent, promising monthly payments between $25,000 and $750,000, while secretly funding these payments through shell companies under his control. The fraud extended beyond revenue fabrication. Sanberg and fellow board member Ibrahim Al-Husseini defrauded 2 investment funds of $145 million through falsified loan documents. The company's claims about environmental impact also came under scrutiny. While Aspiration claimed to have planted 35 million trees, CEO Cherney later admitted to ProPublica that the actual number was only 12 million. Federal investigations began in January 2024, with the Department of Justice and Commodity Futures Trading Commission examining misleading claims about carbon offsets. Al-Husseini was arrested in October 2024 and later pleaded guilty to wire fraud, admitting to receiving $12.3 million in ill-gotten gains. Sanberg was arrested in March 2025 and pleaded guilty to defrauding investors of $248 million. The company filed for Chapter 11 bankruptcy on March 31st, 2025, reporting $50 to $100 million in assets against $100 to $500 million in liabilities. Major creditors included the LA Clippers and Kia Forum, owed $40 million for contracted carbon credits, and Kawhi Leonard's LLC, owed $7 million. Despite the parent company's collapse, the consumer banking business found new life through a strategic spin-off. Tim Newell, Aspiration's former COO, acquired the consumer division through his company Mission Financial Partners in early 2024. Rebranded as GreenFi, the business secured $17 million in seed funding to continue offering sustainable banking services. Existing customer accounts transitioned seamlessly, maintaining their fossil fuel-free status and core features. Several key lessons emerged from Aspiration's collapse. First, mission-driven positioning requires rigorous execution integrity. Overstating impact claims creates existential risk. The gap between marketing claims and reality ultimately triggered federal investigation and damaged credibility. Second, governance failures can undermine even strong impact models. as B Corp certification and celebrity backing don't guarantee good governance. Third, innovative revenue models must still produce sustainable economics. The pay what is fair model attracted customers but created unpredictable revenue. The market opportunity aspiration identified remains valid. McKinsey research shows 40% of U.S. consumers are interested in climate linked financial products. The company's thesis that changing banks could significantly impact individual carbon footprints resonated with millions. However, the execution failed to match the vision. The separation of assets during bankruptcy proceedings proved crucial for protecting consumer interests. While the corporate ESG business, rebranded as Katona Climate, entered bankruptcy, the consumer banking operation continued under new ownership. GreenFi inherited the consumer brand, account infrastructure, Redwood Fund, and merchant network while leaving behind the corporate contracts, legal liabilities, and criminal investigation targets. The aspiration story demonstrates how quickly trust can erode when mission driven companies fail to live up to their stated values. While the consumer business continues under new ownership as GreenFi, the broader cautionary tale serves as a reminder that good intentions must be matched with strong governance and honest reporting to create lasting positive impact. Future sustainable banking ventures must learn from these failures while maintaining focus on the genuine consumer demand for environmentally conscious financial services.